Good afternoon, everyone. Thank you for joining us in today's webinar. This is the final webinar in our online webinar summit. We're excited to introduce you to Eric Meyerhoff. Eric has been educating employers on compliance since 2012, and his focus has been on ERISA, COBRA, and FMLA. Today, he'll be giving us a high-level overview of ERISA, and we're excited to have him, and we appreciate his time. And that's my big introduction. I'll let Eric take it from here.
Awesome. Good afternoon, everybody. I usually say with a start, to show of hands, can anybody hear me? But I know that you can't see me and I can't see you, so I won't ask. Today, I'm going to give you guys a 60,000-foot overview of ERISA, not the 401k and retirement side of ERISA, but actually the health and welfare side of ERISA, specifically Chapter 7. We could probably take days, if not weeks, to go over everything. So this is going to be just a general overview on what it is, what you as employers need to really be compliant in. Most on ERISA, nobody really cared about. So the acronym of ERISA, for those of you who are unsure, it stands for the Employee Retirement Income Security Act. It was actually established in 1974. I always like to say that ERISA for me stands for every ridiculous idea since Adam, because most of the items that the federal government placed into this law are ridiculous. But this has been around since 1974. And what folks don't understand is that the same types of things you would do for a retirement or 401k plan, you actually must do for your health and welfare benefits, which we'll go over. No one's really done these items for the health and welfare benefits, and it's really nobody's fault. People were just unaware until about 2012, and that's kind of where this started. So today, we're going to kind of go over why are folks and employers out of compliance. Again, it's nobody's fault, just no one's aware of what really needs to be done. Most employers feel that the carriers, the documents that they receive from the carriers are compliant. They are state compliant, they're just not federally compliant. And there's a lot of confusion out there on the regulations and, of course, prior limited enforcement. And when I say that, from 1974 to about 2012, nobody really was concerned on ERISA health and welfare. They were obviously concerned about the retirement side because that's exactly what was audited. In 2012, and the reason that there was poor enforcement, or limited enforcement, I should say, prior to 2012 is because of ACA. So when the Affordable Care Act came out in 2012, the government decided that it needed to really raise revenue to pay for the Affordable Care Act, and the way that they decided to do that was through enforcing Chapter 7 of ERISA, Health and Welfare. So some of the topics we're going to kind of go over today. We're going to define ERISA. We've kind of done that. Who's subject to it? Unfortunately, most of us are. Definition of what a welfare benefit plan is. What other benefits? Are there any safe harbor exemptions? Some key requirements, the basic rules, summary plan description, the SPD, commonly referred to, disclosures, and then annual 5500 reporting. So, as I said, in 1974, ERISA was enacted. Basically, if you think of ERISA, think of it as disclosure and then disbursement. So you need to disclose to the covered individuals or your employees what you're actually offering them regarding health and welfare benefits, and then you need to distribute what you're offering them in a federally required way. There's been strict enforcement over the past 5 years on this. Again, it was actually a lot of enforcement on the retirement side from 74, but on the health and welfare side, there's just been a ridiculous amount of enforcement that's been going on. The Department of Labor is actually the wonderful federal department that handles ERISA. They are not the only ones who can come in and audit an employer. The Internal Revenue Service also has the ability to do so, but usually these audits that happen today are started by the Department of Labor. At the end of this presentation, there's a list of just some examples of some fines. I like to throw some cases out just to get your attention on what's going on. You know, what would I be as an employer fined for? The simplest thing of not giving out a summary plan description can result in a $110 per day fine for the employer. But these are just some of the ones for failure to provide. So obviously $241,000 fine, that was plenty of years of not providing the document. So when the employee had requested it, the employer just did not do anything, and when they were taken to court, they were obviously awarded that money. So the fines, the average penalty on non-compliance of ERISA is about $10,000. There is a Department of Labor website that actually talks about what you as an employee can do and where you can go to make a complaint on behalf of yourself against the employer. Most folks don't know that, but the DOL has actually put that out and given you a couple of links that you can look at. Let's kind of get into exactly what ERISA is talking about. So, health and welfare. What every employer needs to do is on their health and welfare benefits, and that's medical, dental, life, vision, disability, wellness benefits, flexible spending accounts, voluntary programs, any type of health and welfare benefit. There are several things that need to be done regarding the reporting and disclosure of what, in fact, you're doing. ERISA encompasses some COBRA, FMLA, HIPAA, and some other things which we're not going to dive into today, but for every health and welfare benefit that you offer, so if you as an employer simply offer medical, dental, and vision, those three benefits must have a ERISA summary plan description attached to it. The carrier provides you with a summary plan document or a certificate of coverage, summary benefits and coverage. So the carrier provides you with those documents that are state compliant, but what you as an employer must provide is an actual ERISA summary plan description for those. What is a welfare plan? Again, any plan established by the employer, and this is where it gets a little tricky on voluntary benefits. Some believe that it's a voluntary benefit. It doesn't need to comply with ERISA. Unfortunately, if the employer is endorsing the voluntary plan, or if the employer is putting it on their letterhead, if they're payroll deducting, if they're pre-taxing, there's several things that if the employer is doing make it a welfare benefit plan under ERISA, and therefore it too must go through the requirements. These are the typical types of benefits that are subject to ERISA. Again, your health, dental, vision, those are the major ones. Flexible spending accounts. If you're just offering a Section 125 premium only plan, the Section 125 premium only plan actually sits outside of ERISA, but as soon as you add a full plan, which is the unreimbursed medical, dependent care, possibly transit and parking accounts, those fall under the FSA or the flexible spending account, that must comply with ERISA. HRAs, accidental death, dismemberment, group term life, short-term, long-term disability, severance, wellness. Now the wellness and employee assistance programs, if those are actually included with your health carrier, it does not, it's just automatic and you don't have to worry about it. If it's a separate benefit from a separate carrier, then obviously that would be included. And then the very last one there, the voluntary benefits. And these are programs like your Aflac, Colonial, Allstate, Unum, those types of programs that are considered voluntary, they're actually subject to ERISA. Who, as far as the employer, is subject to it? Pretty much everybody. Any employer that has one or more employee who offers benefits is subject to ERISA. The only two organizations that are not subject to ERISA, the government, of course, because they came up with a law, so why should they have to follow it? So they are not subject to ERISA. And church organizations. So if they file it as such, as a religious organization, commonly referred to as a church organization, church plan, they are actually exempt from ERISA. But everybody else must comply. So that's, again, pretty much everybody. Key requirements under the law. And this is usually what happens when I go and meet with employers. They ask, Eric, what do we need to do? So for every benefit that you offer, you must have a separate ERISA summary plan description. So that plan document must exist for each plan. Now, most people refer to a wrap document. The wrap document is actually the ERISA summary plan descriptions all underneath one umbrella. So if you think about a wrap document, you can think about a binder of a book. So within this book, we're going to have all these chapters on all the benefits that you offer, and then the binder itself is really the wrap document. It just encompasses everything that you're offering. Most, if not all, employers don't realize that they need a fidelity bond. It's commonly referred to as an ERISA bond or a fidelity bond. I've even heard it referred to a COBRA bond in certain situations, but a fidelity bond must be used. And that's because some of the benefits that you're offering, those are considered plan assets, and the employer itself must cover a plan asset, and which is why they are required to have a fidelity bond. The fidelity bond is not expensive, and it's something that a property and casualty broker can assist you with. But I think in the 6+ years I've been doing this, not one single client I've met with had any idea that they needed one, if in fact they even had one. Summary plan description, the SPD. Unfortunately, carriers call their documents SPDs, and they really shouldn't, but they do. So when people say, oh, I have an SPD, they probably have an SPD from their carrier. So if it's Blue Cross, Blue Shield, whoever it is, they provide a summary plan document. It's completely different than a summary plan description under ERISA. So the document that is given to the employer by a carrier is compliant with only the state that they're in. It's not federally compliant. So when an audit letter shows up, actually the very first question is, please provide a copy of your summary plan description. 99% of the employers send in their summary plan documents from the carrier, and that results in a letter back from the DOL stating, we appreciate what you've sent in, but this is not an actual SPD. Please provide the SPD. And so there's a lot of confusion. Again, the ERISA requirement number one is every health and welfare plan must have its own summary plan description. Some of you may have heard of the summary of material modifications. So ERISA basically has what we consider a 5-year life cycle. So the very first year that you seek to get these documents, they're obviously all created brand new. Years 2, 3, and 4, if you have any changes in your plans, let's say you change a carrier, you add a benefit, you take away a benefit, perhaps you move your office location, any material change that you as an employer do, you actually must tell the employee, educate the employee through a summary of material modification of that change. So any and all changes must be documented. The SMM is really a 1-page document, and it just basically says, hey, we've had a change, here it is. Nobody's doing those today, but those have to be done for changes. So the 2nd, 3rd, and 4th year that you have your ERISA documents in order, any and all changes are done via the summary material modification. But year 5, all of your ERISA documentation must actually be redone as if it was brand new. Unless you've had no changes whatsoever in your plans or anything, if you've had 0 changes, then you actually don't even have to do a new documentation of ERISA for 10 years. So that's why I say normally ERISA has a 5-year lifespan, because people make changes every year. Now, these changes, for example, if you take away a benefit, they actually have timelines. The Department of Labor has set up timelines that you would need to make sure the employees or participants get notification of a change. So if it's something that's pro, the employee, they may say you have 210 days to get that notification out. But if it's something that's against the employee, maybe you took away a plan, you changed some coverage. I don't know if anyone has read the articles on Macy's today, but Macy's is in the midst of a Department of Labor Health and Welfare lawsuit because of certain changes they made and that they were not distributed to their participants and employees. So if it's a negative change, you may have 90 days to get that form out to the employee. These are all things that we as a company provide and help employers assist to make sure that they're aware and know when these documents need to be sent out. Other key requirements, there's obviously plenty of different documents within the ERISA summary plan description that must be set up. For example, the medical loss ratio policy, which I'll touch on in a couple of minutes. Form 5500, as of today, if you have 100 or more participants in any one of your benefits, you must be filing a 5500. 5500 form is nothing more than a document that describes and discloses to the Department of Labor what benefit are you offering, what are the premiums that you're paying for, how many participants do you have. It's a simple form, but most employers feel if they don't have 100 participants on their medical, but maybe they have 100 on their life insurance, they don't need to file it. Unfortunately, that would be incorrect. I like to use the example of an employer that may have 120 employees. Perhaps 60 of those employees are participants on the medical, and the employer, so if it just has 60 participants, technically the employer does not need to file a 5500. However, if the employer is providing a group life policy that covers all 120 employees, they actually do need to file. So we find a lot of clients just unaware, again, of what needs to be done. The Department of Labor absolutely loves the fact that people don't know what's going on, and they use that to their advantage, especially when it comes to 5500 filing. The penalty for a non-compliant 5500 today is over $2,100 a day. There is no really statute of limitations. I have heard the Department of Labor say that, I mean, generally it's a 3-year audit look back, and the DOL has said that they'll go back to 1988 if they need to. We haven't seen anybody do that as of yet. Most of these audits, again, are just a 3-year look back, but the 5500s are where they're actually collecting the most in fines because people are just unaware of what needs to be done. Now, if you do not have 100 or more participants in a plan, then you absolutely have no worries on that. The summary annual report goes along with the 5500. It's just another document that goes out to your participants and basically explains everything that you just filed with the Department of Labor. So if you don't file a 5500, you do not need to file a summary annual report. A little confusing, but hopefully that makes some sense. Some other basic rules: you have to provide these documents to your participants and some of them to all of the employees through a compliant manner. Now today, years ago, it would obviously have to print forms out and hand them out to the employees. Today, obviously, with email, you can send most of this stuff via email. There are certain requirements that you must do, which we can help walk through, but at the end of the day, if your employees have an email address, it's going to be the easiest way to distribute this. So just because you may have the documents, you still have to distribute it. So that's just part of the compliance that you need to be thinking about. Is that's great that maybe we have these documents, and again, I'm sure most of you on the call do not, because it's just no one has this stuff until they're looking at an audit. But once we get you these, or you go out and you get all these documents, or you create them yourselves, you still must give them out to your participants. Another confusing item with ERISA is if your plan year, for example, was a June 1, or let's say a July 1 to June 30. Let's say your medical plan started July 1st and ended on June 30th. If you do not have an ERISA summary plan description, your actual plan year, your ERISA plan year, goes January 1st. It goes based on the calendar year. So if you're an employer that may have 100, let's say 120 employees, and maybe on July 1st, only 99 of those employees were participants in the medical, you would technically not need to file. But if you did not had 100 or more participants on January 1st, you would technically have to file. So again, goes back to the confusion because people are just unaware that their plan year really goes based on ERISA. So that's why they need these documents. Okay, wrap document. This is the most commonly referred to term with ERISA. I hear people say, I just need a wrap document. I don't need anything else, just a wrap document. Unfortunately, the wrap document is just part of what an employer needs. Technically, you don't even need a wrap document as long as each of your health and welfare benefits contains an ERISA summary plan description. What the wrap document really does is it makes it much easier to cover all of your benefits under one umbrella. So instead of Plan 501 for your medical, Plan 502 for your dental, 503 for life, if you wrap them underneath a document, you can just have Plan 501. It just makes things easier. Some of the items that are required in the wrap document, you have to designate the plan administrator, who's the fiduciary, plan year, plan name, plan number. Again, how many plans you have. A lot of this stuff is easy, but has to be done. How many plan documents are obviously going to depend on how many plans you have. Remember, the 401k or any type of retirement type program are completely separate. So sometimes I get the question, we have all of these documents under our 401k plan. Is that okay? Can we use that for our health and welfare? Unfortunately, no. If it were up to me, I'd say sure, but I'm not the Department of Labor, and according to the Department of Labor and ERISA, those things have to stay completely separate. I like to say simple. So we talked a little bit about the the cafeteria plan. So if you're just offering that Section 125, you still have to have your medical. Let's say you're going to pre-tax the medical for your employees. The medical plan itself must fall under ERISA, but the Section 125 premium only plan would sit out of ERISA. I'm not going to get into the bundling. Summary plan description, again, the one thing to be aware of, most employers felt in the past it was 50 or 100 or more employees. The ERISA statute is 1 or more employees. So if you have a company with 2 people, one is an employee, you must follow ERISA. And again, this is why the Department of Labor is able to access a lot in penalties and fines, because they're going after every employer that's got 1 or more employee, because people don't know and they feel, I only have a couple of folks, why do I need to worry about it? Because it's the law, unfortunately. Couple of timelines. So again, when you first create, or if you used our service to create all of these documents, you're going to want to get these things out within 90 days. We will, of course, educate you on the timeline. There's a bunch of different dates on different forms that need to be given out, but generally within 90 days. New plans, you want to make sure it's disclosed within 120 days. If there's, again, no changes, which today I don't know any employer who doesn't make any changes whatsoever. But if you had absolutely no change in your benefits, you would not have to renew these documents but once every 10 years. Updating. So again, the summary material modification we kind of went over. Let's see here. Penalties. Again, these are just some examples. I'm going to show you in a little bit some others. HHS, Health and Human Services. So the Department of Labor and the IRS work together. And I'll give you an example. Some of you may be aware of the Healthcare Reform Model Exchange Notice. So under ERISA, there are between 7 to probably 40 different notices Most employers really only require between 7 and 14 notices that must go out on or close to your renewal every year. The Department of Labor and the IRS do work in conjunction with these notices. So in 2013, the Healthcare Reform Model Exchange Notice came out. So if you're asking yourself, I have no idea what he's talking about, then definitely get with us later. But the Healthcare Reform Model Exchange Notice basically was a notice that all employers with one or more employee who offer benefits must give out to their employees. In fact, it must go out to all employees, not just participants, but every single employee. And it must have been given out for new people, so new hires that come in within 14 days of when they were hired. So in 2013, when you first were given the notice, or hopefully downloaded the notice, it had to go out to everybody. Now the Department of Labor came out and said, it's okay, we're not going to impose any fines or penalties if you don't get it out to everybody. So most people thought, okay, we're good. The Internal Revenue Service actually came out and said, you have to give this notice to everybody, and if you don't, then we're going to impose a $100 per day per employee fine for non-compliance of giving out the notices. So when you're dealing with either an ERISA attorney or a third-party administrator like us, we're going to give you the extremely conservative answer of these have to go out to everybody. So like I said, there's about 7 to 14 that are the normal that must go out on or close to renewal every year. A lot of employers may do a couple and are just unaware of all of them, but that initial or Healthcare Reform Model Exchange Notice, that's the one that most people were aware of and just either didn't send out to everybody or were unaware that they needed to get it out to everybody. And in fact, unaware that for new hires, they need to make sure they get it. So again, these are the kind of things that we would make sure you're compliant with. Providing copies of the documents on written request. If an employee comes to you and asks you for some documents, it's probably a pretty good idea that that's a red flag because I haven't had any employer come to me in the past 6 years and say, hey, I have an employee who's asking me for this, but they can. Now, if an employee just asks for it, technically you have 30 days to provide it, but normally employees will write via email or letter form, and they'll request it. As an employer, you have 30 days to provide the documentation. If you do not provide it in that 30-day period, the employee does not need to request it again. The employee could actually sit on it and wait for years and then take it to court and say, I requested these documents and I was never given them. And that's where that $110 per day fine comes in. So we make sure, obviously, that anything under ERISA, if you work with us, that excuse me, you're getting these documents out to the employees when they need to go out. So if anyone's requesting it, they should have already received it, which is another good reason why using email is an excellent form of distribution because you can track everything, which is important. All right, we went over that. Again, the 5500s, if you have 100 or more participants on the first day of your plan year, and if most of you do not have a ERISA summary plan description, technically your first day of your plan year is January 1st. So if you have 100 or more participants on January 1, you would need to file the 5500s. If you don't, there is a program the Department of Labor put out called the Delinquent Voluntary Filer Program. We can walk you through that. It's basically a, oops, I messed up, I wasn't aware of it. And again, most companies are unaware of it. And we're talking large companies with a couple thousand employees just unaware that this is what they need to do until the Department of Labor knocked on their door, and then they realized, okay, we have to report it. So there are ways of taking care of it if there's an issue. Again, 2100 is the 5500 form fine. So if it's done or if it's not done compliantly, if it fails, they say there's no statute of limitations. I've spoken to several Department of Labor individuals who have said they would go back to 1988 if the company was still around back then, but the audits that go out today are 3 years. So understanding that no employer is compliant and understanding that that's nobody's fault. It's just because people are unaware. When an audit letter shows up, again, as long as the employer is getting into compliance, the Department of Labor is not going to worry about the past couple of years because they realize that nobody is compliant. So as long as you're doing what you need to do to get into compliance, you should be fine and people shouldn't worry about it. We kind of talked about that. Medical loss ratio. Now I just want to bring this up briefly. This came out 2010, 2011, the medical loss ratio. Basically what it says is that a insurance carrier must use 80 to 85 cents per dollar on claims. And if they don't, the employer, based on a size and an aggregate and whatever they're looking at, based on the size of it, the carrier may give the employer a refund. It could be 20 cents, it could be a couple thousand dollars. They may give a refund, but they may not give a refund. The medical loss ratio policy, when it came out, basically, I like to call it a 3-strike rule. Every employer that has one or more employees must have a written policy on what they're going to do with the refund if they ever get it. So that's usually strike one because no one is even aware of this and no one has a policy. So the first strike is you need to have a written policy. That written policy must be placed within the ERISA summary plan description, which I know is strike 2 because nobody has an ERISA summary plan description because they're just unaware. Strike 3 happens if an employer gets a refund. If they get the refund and they do not have the medical loss ratio written policy within their ERISA document, then technically they need to file 5500s regardless of their participation. So if you have 25 employees and you never established an ERISA document and you never put in the medical loss ratio and you received a refund, the Department of Labor is going to expect you to file a 5500, even if you had 4 participants. So this is the kind of stuff that falls into ERISA, and it's impossible to keep up with this. So if you're sitting there scratching your head or going for a drink right now, this is the kind of thing that it's the reason that you want to use a third-party administrator or somebody else to handle this for you. You want someone who actually does this on a day-to-day basis because it's impossible to keep up with it. These are just some fines, some listings. Usually it's because there was no document, no SPD. The employee asked for something, the participant asked for a certificate of coverage or whatever, an SPD, and the employer just said, oh, well, here's what we have, but they never provided them the actual document. That's a lot of these fines. There's actually the Department of Labor has a data enforcement website, and I know most of you on this call are not as interested in compliance as I am. I absolutely love compliance and I love doing a lot of this research. But the Department of Labor has a data enforcement website. It's public information. You can actually go on there. You can put a zip code in and you can see which companies in or within that zip code have been targeted by the Department of Labor already, how much they've been fined and for what. And so these are just some examples. Not to give you the 10th degree here, but ERISA is extremely important to comply with. No one, unfortunately, is aware of what's going on, so we want to make sure that you're aware that this is a law. Yes, I have some clients that say, well, you know what, I'm just going to wait until I get an audit letter. When an audit letter shows up, you have 10 days to respond to the Department of Labor. It is actually a 10-page audit. It's 63 questions. I have not seen a single client pass one of those prior to dealing with us. So when they fail this 10-page audit letter, the Department of Labor sends them a 13-page failure letter, and then it identifies what the employer must do to rectify and only gives them 10 days to rectify. So when people ask me, well, what's the chances of us getting audited? Well, at the end of the day, the Department of Labor on their website states that they will audit all employers at some point. It may take years. I know dealing in the New York market that I've done in the last 5 years and now in New England, in the New York market, we would see between 1 and 3 audit letters a day. It's starting to gradually come up to the New England market. I've seen a couple in Boston, a couple in Rhode Island. The Department of Labor headquartered in Boston is the one that's actually giving out these audits. So it is on its way up to the Northeast. It's probably only a matter of time before they start more rigorous enforcement. Just to give you an idea of what they're collecting, the first year that the Department of Labor actually went out to do the audits, they had a budget of $183 million. They hired 1,003 auditors, and they actually collected about $1.72 billion, that's with a B, in fines the first year. So each year that they're out there auditing, they're collecting a ton of money. So we don't see any reason why they would stop. I get asked, well, what if ACA goes away? ERISA has been around since 1974, and I don't think that's going to go anywhere anytime soon. I don't know if you guys can do questions or not.
Does anyone take a question? We'll give you guys a few minutes here, and again, you can feel free.
Maybe a shot of vodka and some aspirin.
You're welcome to obviously ask your question. We can certainly hear you that way, or there's a questions box. You can always type a question in there if you don't want to talk out loud. And then there's always, obviously, I always say if you're anything like me, you'll think of questions, at 10 o'clock at night. And if that's the case, please feel free to reach out to either myself or your account manager, and we can certainly connect you with Eric for sure. So it looks like we're okay with questions. So I just wanted to take a minute and thank you, Eric, for taking time to do this for us. It's such an important topic, and obviously it's better to be in the know, and we prefer that is how our clients operate. So we appreciate your time, and I appreciate everyone's time on this call that took the hour out to join us, and I hope you found it to be very useful. And please feel free to reach out if you have any questions about the presentation, or if you wanted to contact Eric directly for services or anything along those lines. So thank you, and I hope everyone has a great afternoon. You're very welcome. Bye-bye.